Welcome to the deep dive. We sift through the noise, the sources, to bring you, well, hopefully, the clearest, most actionable insights.
That's the plan.
And today, we're diving into something pretty significant for a lot of people. Mortgages. Specifically navigating the complexities when you're buying a home.
Right. It can definitely feel like wading through alphabet soup sometimes. Acronyms, jargon.
Exactly. Like imagine a couple, let's call them Sarah and Tom. They're trying to buy their first place, super excited, but also kind of overwhelmed.
A very common scenario.
And two terms keep cropping up in their research.
Yep.
Interest-only mortgages and this thing called the loan-to-value ratio, LTV,
Oh.
and its cousin, CLTV.
Combined loan to value, yeah. Crucial stuff.
So our mission today is basically to unpack those. What do they actually mean? How do they work in the real world? And, why should you or Sarah and Tom actually care?
It's about turning that dense info into clear insights.
Yeah, because understanding this stuff isn't just about avoiding nasty surprises down the road, right? It feels like it could unlock some real financial understanding, maybe even power. I'm actually really keen to get into this.
And I'm ready to lay out the groundwork because these aren't just, abstract terms bankers throw around. They are fundamental. They're how risk and opportunity get assessed in real estate.
Okay.
So whether you're a first-time buyer like our Sarah and Tom, maybe think about refinancing, or honestly just curious about how property finance works, like getting a grip on these concepts can really empower your decisions.
Okay, let's do it. Let's unpack this. First up, interest-only mortgages. The name itself sounds, well, it sounds appealing, doesn't it? Like it could really help with those monthly payments initially.
It does sound appealing, and that's the main draw.
So what are we actually talking about here? What is an interest-only mortgage?
Okay, so simply put, it means for a set period of time, that's key. A set period you, the borrower, are only required to pay the interest that accrues on your loan each month.
Just the interest.
Just the interest. The principal, the actual loan amount you borrowed, you don't start paying that back until later.
Ah, okay. So it's deferred.
Exactly. Deferred repayment of principal. And the immediate appeal, like you said, is pretty obvious. Those initial monthly payments are significantly lower than they would be on a standard mortgage where you're paying both principal and interest from day one.
Which means more cash flow flexibility.
Precisely. That can be super attractive, especially, say, for first-time buyers like Sarah and Tom who might be stretching their budget, or maybe they expect their income to go up significantly in a few years.
Or they want to use that freed up cash for something else, renovations maybe, or other investments.
Could be. It provides that initial breathing room.
That initial lower payment sounds amazing. But, how do these usually get structured? Is it just, okay, pay only interest for 5 years at this rate? Or is it more complicated?
It's usually a bit more nuanced. Most interest-only mortgages you'll find are actually structured as adjustable rate mortgages, ARMs.
The ARMs, right? Heard of those.
Yeah. So you might see something advertised as, say, a 71 ARM with an interest-only feature.
Okay, what does the 71 mean again?
Good question. The 7 means you'll make those interest-only payments for the first 7 years. That's your introductory period. The 1 means after those 7 years, your interest rate will start adjusting annually.
Yeah.
Okay.
Annually based on market rates or something.
Exactly, tied to some index plus a margin. And crucially, after that initial period, the 7 years in this example, you also start repaying the principal.
Got it. So the payment jumps up then, potentially by a lot.
Potentially significantly, yes.
Right.
Because now you're paying principal and interest, and the principal has to be paid off over the remaining loan term, which is now shorter. Common introductory periods are often 5, 7, or maybe 10 years.
Are there fixed-rate interest-only loans, or is it mostly RMs?
Fixed-rate interest only exists, but it's much less common. You might find it on some longer, like 30-year loans, but the ARM structure is definitely more typical for these.
Okay. And that switchover point after the intro period, what do lenders call that?
They call it converting to a fully amortized basis. Fancy term, but it just means you're now paying both principal and interest, calculated so the loan is fully paid off by the end of its term.
Right. So for Sarah and Tom, the big pro is that immediate cash flow boost. Helps manage the bills, maybe lets them save a bit on the side, defers the bigger payment pain.
Absolutely. Increased cash flow, easier monthly budgeting in the early years. That's the main advantage. It can be a real help if money's tight initially or if you have other big expenses.
It almost sounds like a bit of a mortgage hack, but finance rarely gives you a free lunch. There has to be a downside. What are the big cons, the risks Sarah and Tom absolutely need to understand?
You're right to be cautious. There are significant risks. Probably the biggest one is that during that entire interest-only period, you are building zero equity in your home through your mortgage payments.
Zero.
Yeah.
Because you're not paying down the principal.
Exactly. Equity comes from two main sources: paying down your loan principal or the property value appreciating. With interest-only payments, you're only covering the cost of borrowing. You're not reducing the debt itself.
So unless the house price goes up significantly.
Your loan balance stays exactly the same for those first 5, 7, 10 years. And that leads to the next big risk, the payment shock.
When the principal payments kick in.
Yes. When that loan converts to fully amortized, your monthly payment can jump dramatically. If Sarah and Tom's income hasn't increased as much as they hoped, or if something unexpected happens, job loss, medical bills, anything, that higher payment can become unaffordable very quickly.
Posing a default risk.
A serious default risk. It really demands very careful, honest planning about your future financial situation. And maybe think about the opportunity cost, too.
Opportunity cost.
Yeah, those years, you're only paying interest. You're not building that forced savings that comes with principal repayment. You're missing out on the potential compounding effect of paying down your debt earlier. It fundamentally changes your long-term wealth-building path compared to a standard mortgage.
That's a really critical point. It's not just about the payment later, but what you're not gaining now. So, okay, the interest-only period ends. Payment shock looms. Are borrowers just stuck, or do they have options?
They usually have a few routes they can explore. Refinancing is a common one.
Trying to get a new loan, maybe a standard one?
Yeah.
Before the payments jump.
Exactly. Or maybe refinance into another ARM, hoping for better terms. Selling the house is another option, of course, especially if the value has gone up enough to cover the loan and costs.
Pay it off and walk away, hopefully with some profit.
Right. Or, for the really disciplined folks, maybe they've used the lower payments period to save aggressively. Then they could make a lump sum payment towards the principal when the amortization starts to reduce the overall loan balance and subsequent payments.
That takes serious discipline.
It certainly does. And interestingly, some niche interest-only loans might even have specific clauses, like allowing you to revert to interest-only payments temporarily if your home gets significantly damaged, say in a natural disaster, to help with repair costs.
Huh. That's a specific detail. But the core issue remains, doesn't it?
Absolutely. What's fascinating really is this fundamental trade-off. You get that immediate cash flow, that flexibility up front.
But you take on potentially significant future financial strain, you build equity much slower, and you're exposed to interest rate risk if it's an ARM.
Precisely. Which leads to the big question for you, the listener, considering this. Is that short-term relief genuinely worth the long-term gamble for your specific situation? You really have to weigh your risk tolerance, your income prospects, your savings habits.
Yes, Sarah and Tom would need a very serious conversation about that. Okay, let's shift gears. We've talked about payment structures. Now let's look at how lenders assess risk using ratios. The loan-to-value ratio, LTV. Sounds fundamental.
It is absolutely fundamental.
So LTV. It's something lenders use to decide if you qualify, what interest rate you get. How is it actually calculated?
It's actually a pretty simple calculation. You take the loan amount, how much you want to borrow, and you divide it by the appraised value of the property. Not necessarily the price you paid, but what the independent appraiser says it's worth.
Okay, loan amount divided by appraised value.
Yep. And then you express that as a percentage. So let's take Sarah and Tom again. If they want a $90,000 loan for a house that appraises at $100,000.
$90,000 divided by $100,000 is 0.9, so 90% LTV.
Exactly, 90% LTV. Now, why do lenders care so much about this number?
Risk, I'm guessing.
Risk, pure and simple. From the lender's perspective, a higher LTV means the borrower has less skin in the game, less equity cushion.
Meaning if the borrower defaults.
And the lender has to foreclose and sell the property, there's a higher chance they won't recover the full loan amount, especially if property values have dipped or there are selling costs.
So higher LTV equals higher risk for the lender.
Which generally translates to a higher interest rate for the borrower, or potentially stricter qualifying criteria.
And this is where that other acronym comes in, right? PMI.
Yes, private mortgage insurance. This ties directly to LTV. If you're getting a conventional loan, not FHA or VA lenders typically require you to pay PMI if your LTV is above 80%.
So if your down payment is less than 20% of the home's value.
Correct. And PMI isn't for your benefit. It protects the lender if you default. It can add, roughly 0.5% to 1% of your loan amount to your costs annually, often paid monthly with your mortgage payment.
Ouch. An extra cost just because your LTV is high.
Exactly. And you generally have to keep paying it until your LTV drops to 80% or sometimes even 78%, either through paying down the principal or if the home's value appreciates significantly and you get it reappraised.
So that 80% LTV mark seems like a key threshold. Is that the good LTV number to aim for?
For conventional loans, yeah, 80% LTV or lower is often considered the sweet spot. Getting below 80% means you avoid PMI and you'll generally qualify for better interest rates.
And above 80% means higher cost, maybe tougher approval. What about really high LTVs, like over 95%?
Lenders get increasingly wary. LTVs above 95% are often seen as very high risk for conventional loans and might be difficult to get approved or come with very high rates and PMI. So back to that $100,000 house. An $80,000 loan is 80% LTV okay. But if Sarah and Tom could put down more, say get only a $75,000 loan.
That's 75% LTV. Better terms, no PMI. Definitely advantageous.
Absolutely. It makes a big difference over the life of the loan.
Okay, so 80% is the conventional benchmark.
Hmm.
But you mentioned FHA, VA. Are the LTV rules different for those types of government-backed loans?
Yes, very different. They're designed to help specific groups of borrowers. FHA loans, for example, backed by the Federal Housing Administration, are popular with first-time buyers or those with less than perfect credit. They allow LTVs up to 96.5%.
Wow, so only a 3.5% down payment needed.
Right. But there's a trade-off. FHA loans require a mortgage insurance premium, or MIP, and unlike PMI on conventional loans, FHA MIP often lasts for the entire life of the loan if you put down less than 10%.
For the whole 30 years. Ouch.
Yeah, that's why many FHA borrowers aim to refinance into a conventional loan once their LTV hits 80%, just to get rid of that lifetime MIP payment.
Okay. What about VA and USDA loans?
Those are even more unique. VA loans for eligible veterans and service members and USDA loans for eligible rural properties can actually go up to 100% LTV.
100%, meaning zero down payment.
Correct. Zero down payment required. And remarkably, they generally don't require ongoing monthly mortgage insurance like PMI or MIP.
That sounds amazing. Is there a catch?
Well, they do typically have an upfront funding fee, which is a percentage of the loan amount that can be rolled into the loan itself. But the lack of monthly MI is a huge benefit.
So different programs, different LTV rules. What about the big players, Fannie Mae and Freddie Mac? Do they have special programs too?
They do. They have programs like Fannie Mae's Home Ready and Freddie Mac's Home Possible. These are aimed at lower to moderate income borrowers and also allow for high LTVs, up to 97% in some cases.
Similar to FHA then?
Similar LTV allowance, yes. But they typically use the standard PMI rules, meaning the mortgage insurance can be canceled once the LTV reaches 80%.
Got it. And didn't you mention something about recent changes with Fannie and Freddie fees? How does that relate to LTV?
Yes. That was interesting. In May 2023, they adjusted their loan level price adjustments, which are basically upfront fees based on risk factors. The change meant that, somewhat counterintuitively, borrowers with higher credit scores sometimes faced slightly increased fees, while those with lower scores saw decreases. And the down payment size, which directly impacts LTV, was also a big factor in those fee adjustments.
So it's not just LTV, but credit score, down payment, loan type. It all interacts.
It's a whole matrix of risk factors. And they even have special programs for underwater mortgages where the LTV is over 100% because the home value dropped. Specialized refinance options exist to help those borrowers.
Okay, this is making sense, but it feels like these ratios are just things lenders impose on you. Here's where it gets interesting for me. How much control does the borrower, like Sarah and Tom, actually have over their LTV?
That's the key takeaway, really. You have significant control primarily through one thing: your down payment.
The more you put down.
The lower your loan amount, and therefore the lower your LTV. It's the most direct lever you have. And understanding this is powerful. Every extra $1,000 Sarah and Tom can scrape together for the down payment doesn't just reduce the loan slightly, it lowers their LTV, potentially pushing them below that 80% threshold.
Saving them thousands in PMI over the years.
Exactly. And likely getting them a better interest rate, too. Thinking about LTV proactively and aiming for the lowest possible number through a higher down payment is one of the smartest financial moves a homebuyer can make. It's like compound interest working in reverse for your benefit.
That's a great way to put it. Okay, so LTV is critical for that main mortgage. But you mentioned earlier, it's not always the whole story. Lenders sometimes need a wider lens.
That's right. Especially if you have more than one loan secured by your property, that's where the combined loan-to-value ratio, or CLTV, comes in.
Combined. Okay, so it includes more.
It includes all the loans secured by the property added together, then divided by the property's value.
All loans. Like what?
So your primary mortgage, yes, but also any second mortgages, any home equity loans, any home equity lines of credit, HEL dunks that have a balance drawn, even potentially other loans against the property. Basically, anything that uses the house as collateral.
Can you give us an example?
Sure. Let's say Sarah and Tom's house is now worth $200,000. Their primary mortgage balance is down to $100,000. That's a 50% LTV on its own, $200. Pretty good.
Looks solid.
But maybe they took out a $30,000 second mortgage a few years ago for a new roof, and they also have a $20,000 balance on a HELC they used for, say, college tuition.
Okay, so multiple debts tied to the house.
Right. To calculate the CLTV, you add all those loan balances. $100,000 plus $30,000 plus $20,000 plus $20,000 is 75%.
And divide that by the $200,000 value.
Yep. $150,000 divided by $200,000 is 0.75. So their CLTV is 75%.
Ah, okay. Still under 80%, but significantly higher than just looking at the first mortgage LTV. Why is this CLTV number important to lenders?
It gives them a much more accurate picture of the total encumbrance on the property, the total amount of debt stacked against its value. If there were a default, the lender holding the primary mortgage usually gets paid first from a foreclosure sale, then the second mortgage holder, then the HELOC lender, and so on.
So the holders of those later loans are in a riskier position.
Exactly. And even for the primary lender, a high CLTV signals that the borrower has less overall equity and might be more financially stretched, increasing the overall default risk. It's a more comprehensive risk assessment when multiple loans are involved.
So while my LTV on my main mortgage might look great, if I've also got a big HELOC balance, my CLTV tells a different story about my total exposure.
Precisely. It gives lenders that deeper understanding of your overall financial leverage against the property value, particularly important if you're applying for more credit secured by the house.
Like applying for a new home equity loan.
That's a classic example. You might think, my primary LTV is only 60%, I have tons of equity. But if you already have a second mortgage that brings your CLTV up to, say, 85% or 90%, a lender considering giving you another loan, a third lien position, will be much more hesitant.
Because their potential new loan would be very low on the repayment totem pole if things go wrong.
Exactly. They'd look at the CLTV and might deny the loan, or offer really unfavorable terms, or only lend a very small amount. Understanding your CLTV is crucial before you start thinking about tapping into more home equity.
So ignoring CLTV can really limit your future options if you're not careful. It connects the dots between all your property-related debt.
It really does. It paints the full financial picture of your home as an asset versus the total debt secured by it.
Okay, this has been incredibly helpful. Let's try and quickly recap the key takeaways for listeners like Sarah and Tom. First, interest-only mortgages. They offer that initial lower payment, great for cash flow maybe, but zero equity building through payments early on, and you've got to brace for that potentially much higher payment later. Careful planning needed.
Definitely. High risk if your finances don't improve as expected.
Then, loan-to-value, LTV. That's the big one for your main mortgage. Loan amount divided by property value. Keeping it at 80% or below is generally the goal for conventional loans to avoid PMI and get better rates. And you influence it directly with your down payment.
More down payment equals lower LTV equals better deal. Simple but powerful.
And finally, combined loan-to-value, CLTV. That includes all loans secured by the house first mortgage, second, HELOC. It gives lenders the total picture of your debt against the property, crucial for assessing overall risk, especially if you're seeking more financing.
It's the holistic view of your home equity situation.
Right, so understanding both LTV and CLTV is vital.
Absolutely. And thinking about all this, it raises an important question, maybe a final thought for you, our listener.
Yeah.
How might really grasping these mechanics, interest-only trade-offs, the power of LTV, the reality check of CLTV, how might that deeper understanding actually influence your personal financial strategy? Not just if you're buying a house right now, but for your long-term approach to debt, to equity building, to financial resilience overall.
That's a great question to ponder. These numbers aren't just hurdles to jump over. They're tools, levers that can shape your financial future quite dramatically if you understand how they work.
They really can be.
Well, thank you for joining us on this deep dive into these mortgage essentials. We genuinely hope these insights help empower you and maybe couples like Sarah and Tom out there to navigate your financial decisions with more clarity and hopefully more confidence.
Keep asking questions.
Definitely. Keep exploring, keep learning, and we will catch you on the next deep dive.